I want to explain how to calculate the hurdle rate or the discount rate that companies use to evaluate projects. So remember that espresso stand project that I talked about in a couple of videos before? That project cost, I think, approximately $27,000 at time zero. And then it was going to generate inflows in years 1, 2, and 3. And exactly what those inflows are, I'm not concerned about right now. But the money, $27,000 has to be raised to finance that project. Well, let's say I'm the person who's evaluating whether or not I should invest in this project and spend $27,000 for those future expected inflows. And let's say right now I don't have $27,000, so I decide to borrow it from my parents. And my parents are going to loan me the money, but they're going to charge me a 10% rate of interest. If this project can't generate more than a 10% rate of return for me, it's not going to be worth it, because after I pay my parents back, I won't earn anything extra. So this 10% rate that I'm being charged to raise the 27,000 is called the hurdle rate. It's the minimum rate I have to earn for the project to be worthwhile for me. You'll notice that when I calculated all those cash flows for the project back in Chapter 9, I never subtracted interest expense. That's because interest expense is built into this hurdle rate that we discount all those cash flows with. Now, most companies don't they don't borrow money from their parents. They've got all these assets over here, and these assets are financed by the sources on the right-hand side of the balance sheet, and those sources include debt and equity. And some companies use a combination of debt, maybe 30% debt and 70% equity. So I need to calculate a weighted average hurdle rate that's made up of 30% debt and 70% equity. So to calculate the hurdle rate for a company, I would calculate the weight of debt times the cost of debt And then the interesting thing about debt is I can deduct the interest expense for tax purposes. So if I get to deduct $100,000 of interest expense and my tax rate's 30%, it's going to save me $30,000 in taxes. So I multiply by 1 minus the corporate tax rate when calculating my weighted cost of debt. And then I calculate the weight of equity times the cost of equity. Oops. That's really going to be ugly. It's not easy to write with this this pen. So this is the now dividends on equity are not tax deductible, so I'm not going to multiply by 1 minus the tax rate over here. So if I pay out $100,000 in dividends to my stockholders, I don't get to deduct that $100,000 for as a tax deduction. So here is my weighted cost of debt after taxes and my weighted cost of equity for a combined weighted average hurdle rate, which they also call the hurdle rate the cost of capital. Capital, in this sense, represents the capital or money we raised to fund investments in long-term projects, and we want to figure out the cost of it. So they call this the weighted average cost of capital, which you'll see abbreviated a lot as WACC. So I'm going to demonstrate how to calculate that for the problem that I handed out on Friday. Remember I gave you a handout that had the espresso stand project and calculating weighted average cost of capital on the other side. So if you look at that calculating weighted average cost of capital sheet, it gave you little bits of information that we need to figure out to determine our weighted average cost of capital. And I'm just going to put the formula up here so you can see why I'm calculating different things. So the weighted average cost of capital is the weight of debt times the cost of debt. And they usually write cost of debt as KD times 1 minus the tax rate plus the weight of equity times the cost of equity. So I need to calculate all of these things, except the tax rate, which was conveniently given. So the first question says calculate, or what is the current discount rate for Royal Caribbean? This was a company I chose to use as a demonstration a couple of years ago. It was back when I believe that cruise ship overturned, I think, near Italy. And Royal Caribbean's price, I believe, dropped quite a bit, and its beta went up to 3.48, so it was viewed as quite risky in terms of systematic risk, which just made it interesting. Now, when I calculate the weights, the weight of debt and the weight of equity, I'm actually going to pop back to my PowerPoint slide again. If I look on a company's balance sheet, again, debt and equity, there will be values there. So they have long-term debt, and there's retained earnings, which is part of equity, and the common stock account at par. And then you usually see an additional paid-in capital. All of these accounts, particularly like these two, are on the books at book value, which could be quite a bit different from market value. So if Royal Caribbean had issued stock 15 years ago, then that stock is on the books at the price that it sold the stock to it sold the stock for in the primary market 15 years ago. Companies don't update their balance sheets every day to reflect their current stock price. If investors perceive a company as becoming more risky and they require a higher return, their stock price is going to drop. Their bond prices will drop as well. These bonds are on the books at their issue price, not at their current price, and there could have been a lot of time that passed between the issue date and the current date. So even though I could easily look at their balance sheet and calculate book weights, I would just take this total and then divide, so I'd sum the value of all of these, and then I would divide long-term debt by the total to get the weight of debt, and then the total of equity by the total to get the weight of equity. So even though I could easily do that based on book weights are not relevant because they don't reflect investors' current risk perceptions, because these prices realistically are changing every day in the market, but they're not changing every day on the balance sheet. So instead of using book weights, I need to use market weights because they reflect investors' current risk perceptions of the company. So what I need to do is calculate the total market value of equity and the total market value, forgot the word value there, of debt. And what I know about the debt is that each bond sells for $782. Now, I need to know how many bonds are outstanding because I know the price per bond is $782. And if I knew the number of outstanding bonds, I could take that number times the price per bond to get the total market value of debt. Well, I'm just reading the paragraph on the Calculating Weighted Average Cost of Capital handout. And I can see that it's in the fourth bullet under that main paragraph. It says the book value of debt on Royal Caribbean's balance sheet is $11,396,000. Well, $11,396,582,000. So $11,396,582,000. That is the book value of debt. Well, corporate bonds sell for, or they have a par value of $1,000 a share. So if I divide by $1,000, that should tell me how many bonds are outstanding. So they have, I'll put some commas there, they have 11.4 million bonds outstanding. So to find the total market value of debt, I can take this 782 times the 11,396,000 bonds. And you can see that the market value of the bonds is less than the book value because the bonds are put on the books at $1,000 a share, but the prices declined to $782, probably because the bonds are perceived to be more risky than they were before, making the market value only $9 million approximately, not 11 billion. I'm sorry, billion, not 11 billion. So there's the market value of debt. And you know, this doesn't look that pretty and it's not particularly convenient. So I am going to just move that over there to keep it in line with the market value of debt right there. The market value of equity, the first bullet says the current beta of RCL is 3.48. And the company has 217.84 million shares of common stock outstanding at a current price of $27.30 a share. That's all I need to figure out the market value of equity. So I take the price per share, current price per share of $27.30, times the number of shares that Royal Caribbean has outstanding of stock. So that's 217,840,000 shares. Let me just check that one more time to make sure it looks right. So that's 217.84 million. So market value of equity, market value of debt, total that. So just sum it to get the total market value of the company. To find the weight of debt, it would be well, I'm kind of reversing things, but it would be the market value of debt divided by the total. To find the weight of equity, I could either take 1 minus the weight of debt to get 40%, or I could take the market value of equity divided by the total value of the firm to get the 40%. Doesn't matter which way I do it. So there are these two weights. So now I need to calculate the cost of debt and the cost of equity. The cost of debt is Now, even though the debt that we are aware of that Royal Caribbean has already been issued and presumably already that money has already been spent on things, I can look at the current cost of debt and gauge how much investors are requiring that Royal Caribbean's debt return for them to make it worthwhile investing in. So I can look at their current price on their debt, and it's $782 a bond. That tells me investors have increased their required returns for Royal Caribbean from when this debt was first issued. The debt was first issued with a coupon rate of 6%, but because the debt is selling below par, less than 1,000, it's selling for only 782. That indicates to me bondholders want to earn a higher return than 6%. So if I were to issue new bonds today to convince people to buy them, I would have to return them something higher than 6%. I'd have to return them the same rate that current bondholders are getting. And those current bondholders are telling me what rate they want by how they're pricing that bond in the market, pricing it below par at $782. So think back to chapter 4. I can calculate the promised yield to maturity on current bonds. So what do I know about these bonds? I'm going to just put that information over here in a bracket. The bonds have 22 years to maturity. They have a $782 price, current price. They have a coupon rate of 6% and a par value of 1,000. I'm going to also assume that they make payments annually, not semi-annually. So based on that, I can calculate what promised yield to maturity investors desire using the rate function. So my number of periods would be 22. My payment would be that coupon rate of 6% times the par of 1,000. So it'll be $60, but you can just type in the formula right there. My present value is the current price of $782, but when I use the rate function, if you remember, you need to have a sign change. You've got $3 amounts that you can enter: present value, future value, and payment. At least one of those has to be negative, and at least one has to be positive. I make my present value negative because that's the price I'd have to pay today to buy the bonds. So the 782 is my present value. The future value is that $1,000 par value. So my cost of debt is 8.17%. So I now have this KD. And the tax rate was given, it's the last bullet. It's 30%. Now I need the cost of equity. And what I know about equity is that the beta for RCL is 3.48. The return on the market, RM, is equal to 10%. And the risk-free rate is equal to 3.135%. I'm getting all that information from the first 3 bullets. Now I can use the CAPM to determine the cost of equity. And the formula for the CAPM is risk-free plus beta times 1, or return on the market, minus risk-free. So I'm going to plug in this equation here. So my risk-free rate is 0.03135 plus my beta of 3.48 times the return on the market of 10% or 0.1 minus the risk-free of 0.03135. Just closing all my parentheses. And I'm going to format that as a percentage. So there's my cost of debt and my cost of equity. My weight of debt and my weight of equity. So I can plug everything into this formula. So to find my weighted average cost of capital, I want my weight of debt times my cost of debt times 1 minus the tax rate. Again, the tax rate was 30%, plus the weight of equity times the cost of equity. Ooh, that's a lot of decimals. So my weighted average cost of capital for Royal Caribbean is 14.24%. So when Royal Caribbean is evaluating a new project, if that project is of average risk, 14.24% is the rate they should use when calculating net present value or the discounted payback or the profitability index. And it's the hurdle rate that they should compare the project's IRR or modified IRR to. So that's the answer to question A. Question B asks, what rate should Royal Caribbean use to discount high-risk projects and low-risk projects? A fairly rudimentary way of or adjusting for risk is essentially just adding points to the weighted average cost of capital to allow for higher risk and deducting a premium from the weighted average cost of capital for lower risk projects. So basically it said in the paragraph that the company discounts high risk projects at 500 basis points above the current discount rate. So a basis point, well, interest rates in the United States change at relatively small amounts on a daily basis. So instead of saying interest rates fluctuated by 1/8 of 1%, which some people could find confusing, instead what they do is say 1% is 100 basis points. So if interest rates fluctuated by 1/8 of 1%, then they would fluctuate by 12.5 basis points. 12.5, not 0.125, because I have to multiply that by 100 since 1% is 100 basis points. So a 500 basis point adjustment would be 5 percentage points. So they would discount high-risk projects at the weighted average cost of capital plus 5%. So I'm just going to go plus 0.05 to get that 19.24%. And low-risk projects, they use a discount rate 300 basis points below the current average. So I'll just put minus 300 basis points. So I would take the weighted average cost of capital and deduct 0.03. So essentially what Royal Caribbean would do is, if they were thinking about undertaking a high-risk project, that's their hurdle rate they would use for it. If they were going to review an average risk project, they would use the 14.24% discount rate. And if they were evaluating low-risk projects, they'd use this 11.24% discount rate. Again, this is a relatively rudimentary way of adjusting discount rates, but it is, I think, better than nothing. If you subjected every project to the same discount rate, that would essentially mean you'd probably accept more high-risk projects and accidentally reject more low-risk projects, and that would make your company become riskier overall, which isn't necessarily a good thing. Now, question C asks, is 6 months a sufficient time interval between calculations for the firm's discount rate? Because it said in the given information that Royal Caribbean only adjusted their rate or evaluated their discount rate every 6 months. 6 months might be fine, or it might not be. It really just depends on how volatile your company's stock price is. If your company's stock price is really volatile, that's going to impact the beta of your company. So you need to reevaluate more often, perhaps than every 6 months. If your company's bond prices are quite volatile, then you need to reevaluate more often than 6 months, because that's going to impact this cost of debt. It'll also impact the weights of debt and equity. If you have a very stable company and the stock price and bond prices don't fluctuate very often, then 6 months might be fine.